How to make money holding stocks even if prices fall, simple strategies for success. Greetings. Today, we're going to explain how you can still make money from your stocks even when prices are falling. It might sound surprising, but there are a few commonly used strategies that work to generate income and potentially benefit from a down market when you are a long-term investor who wants to hold shares for a year or more, even if share prices fall. In this video, we'll review how to use dividends, sell call options, and other techniques to make the most out of longer-term stock market holdings. Let's get going. Number 1. The easiest and most common way to make money holding stock shares as a price falls is to collect dividends. Dividends are payments made by a company to its shareholders, usually from its profits. Even if the stock price falls, you can still earn money through dividends if you own dividend-paying stocks. Dividends provide a steady stream of income, which can help offset any losses from a declining stock price. Here is how it works. Dividend yield is the annual dividend payment divided by the stock's price. For example, if a stock pays $2 per share annually and is priced at $50, the dividend yield is 4%. Companies with a history of stable or growing dividends tend to be financially healthy and provide regular income, regardless of short-term stock price fluctuations. Naturally, you would need to own shares of a company that pays dividends. The most reliable way to ensure that they are paid is to buy shares in a company with a strong track record of paying dividends. Blue-chip stocks and dividend aristocrats are often good candidates. Real estate investment trusts or REITs are famous for paying high monthly dividends. For an easy way to keep earning this way, sign up to reinvest your dividends through a dividend reinvestment plan, also known as a DRIP, to buy more shares, potentially benefiting from future price increases. The second way to make money while prices fall is to sell call option contracts. Selling call options is a strategy that allows you to earn income from your stocks even if prices are falling. This involves selling someone else the right to buy your stock at a specified price before a certain date. You receive a premium for selling the call option, which provides immediate income. If the stock price remains below the strike price, you keep both the premium and your shares. This is called a covered call. This strategy involves owning the stock and selling call options on it. If the option is exercised, you sell your stock at the prearranged price. The premium is the fee you keep for selling the call, which is yours regardless of whether the call option is exercised. Here's an example. Say you own 100 shares of a stock priced at 50 and sell a call option with a strike price of 55. First, you will collect the premium from the sale of this option. Then, if the stock price stays below 55, you keep your shares and the premium. If the price rises above 55, you sell your shares at 55 but still keep the premium. It can be a good way to generate extra income, especially in a flat or declining market, but make sure the premium received justifies the potential loss of your stock if the option is exercised. Thirdly, consider selling put options in the company you're holding. When you sell a put option, you agree to buy a stock at a specified price if the buyer of the option decides to exercise it. You collect a premium for selling the put option. If the stock price stays above the strike price, you keep the premium and are not required to buy the stock. Like selling call options, you receive a premium for selling the put. This provides immediate income. If the stock price falls below the strike price, you may be required to buy the stock at the strike price, which could be below the current market price. For example, if you sell a put option with a strike price of 45 and the stock is currently at 50, you collect the premium. If the stock falls below 45, you may have to buy it at 45, which could be a discount if the stock recovers. Only try this strategy if you're willing to buy the stock at the designated put price. It can be an effective way to generate income in a declining market while possibly acquiring stocks at a lower price. Finally, you can reinvest your dividends and use stock buybacks to set up future gains. When share prices fall, strong companies tend to buy back their own shares, which can help increase earnings per share and support the stock price. Reinvesting dividends can help you acquire more shares at lower prices, potentially enhancing long-term returns. Stock buybacks can also support the stock price by reducing the number of shares outstanding. Set up a dividend reinvestment plan, DRIP, to automatically reinvest dividends so that you can take advantage of dips in share price. Companies with strong financial fundamentals often use dividends and stock buybacks to return value to shareholders. Reinvesting your dividends and benefiting from corporate stock buybacks can help mitigate the impact of falling stock prices. Pay attention to companies engaging in stock buybacks as they may signal confidence in the company's future prospects. In summary, these are 4 simple ways to offset falling share prices as a long-term investor. By focusing on collecting dividends, selling call options, selling put options, and reinvesting dividends, you can generate income and potentially benefit from a down market. Remember, investing wisely involves understanding your best individualized strategies and adapting to market conditions. Always seek professional advice to analyze your particular situation and goals. Never invest more than you can afford to lose. If you found this video helpful, please take a second to like, subscribe, and